So if you have student loans, this video is for you. I want to see if maybe lowering your monthly payments can help you save a little bit more in the interim, and then also maybe even save a ton of money long term when it comes to finally paying off these loans. Now, what we're going to actually do is hop over here on the computer and plug in some numbers in real time so we can actually see how impactful these things can change. So if you want to be able to lower your actual payments for your student loans, stick around because we're going to kind of break this down a little bit more and how you can do this. So we're going to actually go ahead and switch over here onto our computer, and we're going to use a calculator. Super simple. Like, we're talking very basic information. You can see there's only 3 numbers to plug in here. So we have our loan amount, we have our average interest rate, and we have our loan term. Now, your numbers are going to probably be different, most likely, and the reason for that, obviously, is everybody's going to be in a different space. But I looked up the averages, and I just want to show you as well, too. So I looked up the average student loan amount, and this is from Education Data Initiative. You can see here it's about $37,000 per borrower. Obviously, yours might be higher or lower. And then we looked at the average interest rate for student loans. It's about 5% for undergrads, and then you can see as high as 7.54 for unsubsidized graduate student loans. So we're going to play with some of these numbers here in real time. And then when it comes to the loan term, you can see that the average borrower takes about 20 years, but realistically, it kind of starts off with a 10-year loan, and that's what we're going to go off of first and foremost. So we're going to go ahead and hop back over here onto this page. Now, I'm using a calculator from SoFi. Now, SoFi is actually a company that I love recommending when it comes to refinancing your student loans. They do a very simple and easy process because it's free to go through the process to refinance your student loans. Most people don't know that. As well as potentially lowering your interest rates and or even just lowering the monthly payments by stretching out your loan a little bit longer. So it might help you in the short term here. Now, I'll have them in the show notes down below for you, as well as a link to another video after this is done, talking about the other companies that you can utilize when it comes to refinancing your student loans. So we have all the tools here for you to help get you through this process. So let's break some of these numbers down and take a quick look. So you can see here, again, we have our total loan amount is $37,000. That's the average. We have our average interest rate starting off with an undergrad at 5% interest, and then a loan term of 120 months, which is 10 years. And you can see these numbers here on the left-hand side. Our total estimated monthly payments is about $400. So that should be about, with all these numbers plugged in, total amount we're already paying back is about $47,000, which means we're paying about $10,000 in interest. So if you're somebody kind of like boggled by how much interest you're paying, it is definitely a lot of money. So how can we potentially have this lowered? Now, again, this is just some of the basics here for us, but what we can do is, for a lot of people, the monthly payment might be what's boggling them down at this time right now, where maybe they're just trying to get into an apartment or a house or try to save up for other really important things, and that $400 might be a hindrance as student loan repayments have returned. And so I want to show you that sometimes lowering the interest rate, of course, is great. Usually when it comes to undergrad, getting anything lower than what you originally got is going to be very difficult. I will be honest with that. There's another option, which is stretching out your loan term, which means you're going to be paying for a lot longer. But the other really important thing is that you don't have to be sitting there waiting for that loan payment to be paid off. You can pay extra on it once funds become available, like you'll get a promotion or a raise to be able to start making those bigger impacts. So what we want to do is look at, if we move this up to a 15-year loan, so if we did 15 times 12 is 180 months. So I just want to show you, switching to 180 months, I'm going to actually bring up my calculator back here. So we started off at 392.44. The calculator will kind of like come and go here in just a second. So if I'm going to hit calculate, you just saw that our payments, oops, let me bring up the other one. Our payments went from $392 all the way down to $292. So almost $100 extra a month that you would have in your pocket for increasing the loan amount by $100. Now, that interest rate would be effectively the same. So the reason that changes is because you're going to be paying for an additional 5 years. You can see their total interest does increase to about $15,600. Keeping in mind that that's only if you don't pay anything extra as you start increasing your income to have any effective change. And also for some people, that extra $100 now today might be really important for them to be able to, again, move into that right direction. Now let's kind of take it up a little bit higher as well for us. So if we go and bring this back up, so if we go to 20 years, so 20 times 12 right there is 240. So that's 240 months right here. If we calculate that, that only drops it down to about $244. So not as big of a change from 15 to 20, but a huge change from 10 to 15 years on our total loan. But still, $244 is a steep cut from nearly $400 when it came to our monthly payments. And that might be doable for somebody to have that extra income for groceries or car payments or other bills that may be necessary for them to survive at this moment, while then maybe being able to pay back a little bit more down the road. Now let's change up some of this information as well too here, because you might be somebody who is in the higher range when it comes to that interest, right? Let's say it's 7.54. So let's kind of reset some of this information here. So 7.54, and then we did 120 months if we go back to our 10-month example right over here. All right, so let's go ahead and say this is where we're at. We have $37,000, 7% interest rate, and then 120 months on our loan. And again, let's say that $429 right over here is going to be a lot when it comes to having to start repaying. And if we can cut it down a couple $100, that can really change things up in the short term while knowing that we can pay extra in the long run. So let's say we can refinance our student loans and get it down to 5%, because maybe these are, private student loans, or maybe these are unsubsidized student loans, and we can get it down to 5%. And let's say we go to the 180 months. So we extend it a little bit while we're lowering that interest rate. So let's go ahead and bring up our calculator right here. So we're doing 429.60, and let's calculate our drop. So this goes back down to the $292.59. So let's go $292.59. You're bringing in an extra $130 back into your pocket to be able to be utilized on any other bills. That is $1,600 in that given year. Now, you are actually going to be paying a little bit more when it comes to the overall loan. So here you can see it's $15,667, where the previous numbers, if we actually replug those in, so 7% at 120 months, was about $14,552. So that actually is not that big of a difference, because we're able to lower the interest rate and extend out the overall loan additional 5 years. Really made an impact on how much we're getting back every month, while not having a massive impact on our total interest that we're going to be paying. And again, I want to always stress this, you can be paying extra towards your loan once your income has increased over time. So it's not necessarily something you had to stick with entirely for the overall course of the loan. You can pay it back faster rather than just sticking with it and paying more interest in the long run. So what's really important here to show is that sometimes increasing your interest rate, even though you are extending out the total loan, can actually still be saving you money in the short term when it comes to having a little extra cash on a regular basis, while obviously having to pay extra interest in the long term if you do not pay any extra once you start increasing that income. Now, again, going through and refinancing your student loans is actually entirely free for most companies when you utilize them. Now, of course, you can go onto the SoFi calculator as well, plug in your information and see what 1%, 2%, 3% interest rate change can have an impact for you on, or extending out the loan term can really have an impact in the short term when it comes to having more money into your pocket. Now, like I mentioned, I have SoFi in the show notes down below if you want to check them out. They give you a nice bonus for using my link, which helps us create more content just like this. And I also will have a video right over here going over some of the top student loan refinance companies to help support you in your journey to save more money.